Hello, everyone. Here we're in part two of the year-end tax planning for 2018. Quite a few tax law changes this year. Have quite a bit of an itinerary. We're going to go through quite a bit of a log of information. I have quite a few notes. I kind of included those in the description of this event. And you can go through there and use some of that as a tickler file or take notes as I'm going through some of this because I'm not writing all the notes out with everything I'm going to say. But we're going to have quite a few topics that need to be discussed before the end of the year. Some of this you can put to use right away. Make sure you don't forget any deductions. And some of these come from questions from viewers. There's a few Facebook questions that I have up on my screen that I will be following up on and hopefully getting answers for these as well. If you have any concerns with your own taxes or you have any personal finance issues that are causing you some concerns or any something that you want to think about or at least have some solutions maybe to, then we will deal with those if you let me know. I do have a comment section off to the side there that I see on my screen. So let's get right to it. So I see some people are starting to get in already. So that is good. I think I solved all the issues also, by the way, with the audio, with the video. I did a little bit of a tutorial and hopefully that is working. And to go from there. So we're gonna start at the top of the list, and then you guys actually get to choose the direction I'm gonna go if you have questions with these items as well. And I will share my screen periodically here. So when I'm doing things here, this is just my screen where I have my notes. We're gonna have a few other things here too where I will be discussing, for example, opportunity funds later in the broadcast. But I guess you can follow along this way. I can be in the corner if you don't mind. You guys let me know what you prefer. Let's start out with some of the deductions people miss. Now, this is going to be as well as individuals as well as business, but these are all going to be important. So one of the big things that I see in my office, and I'm going to pull some of this down so you can see me, is non-cash deductions are probably the easiest and the biggest deductions that are missed. And non-cash deductions are those that are not always so apparent. So if you have a business, you might be deducting, advertising expense, utilities, things like that. But you might not be deducting things that you don't see an actual deduction or an actual cash receipt for. So for example, for businesses, things like per diems instead of actual expenses for meals and entertainment, especially when traveling. For individuals, non-cash deductions, I talk about mileage. Mileage is a deduction for business owners, but it's also a deduction for people if they itemize for things like charitable contributions, if you're doing some charitable work for maybe a church, United Way, Goodwill, other nonprofit organizations. And if you have medical, there is a deduction there as well. And in fact, because these things keep on changing, I'll periodically throw some things out here for this for mileage. So I'm not sure if they're going to put the rates in my little cheat sheet. So actually, I got a new cheat sheet here that I haven't looked over real close yet. And the mileage rate should not have changed for the medical or the charitable. I don't think it's changed either. But you do get a deduction for the mileage for business. You also have a choice in business of using actual expense versus using the mileage rate. If you use the mileage rate, you can go to actual expense at some later time with some adjustments. And if you go to use actual expense, you cannot go back to mileage with that same vehicle. Let's go to per diems for another deduction that is missed. So meals and incidentals. Let me talk a little bit about some of these things that, again, that are non-taxable, or excuse me, not non-cash deductions. If you're in business or if you have rental properties, you have some kind of event, even if you're doing something for charity in some cases, even meals sometimes for medical can come into play here. Meals and incidentals are basically about $58 under the high-low method. And what it does is it includes a meal allowance and it includes some incidentals, which usually is $5 a day. If you're a fairly frugal person, you can go ahead and deduct the full $58. You got to divide by 2 because only 50% counts. But that sometimes can be a bigger deduction than actually taking the actual expense. Here's the nice thing about per diems. If you're a business owner, you have rental properties, you have a small business, a sole proprietorship, small corporation, You can deduct the mileage, or excuse me, you can deduct your actual expense for meals sometime, and sometimes you can change your mind and actually use a per diem. Here's how it works. Each trip can be treated separately. So maybe you're meeting with a client, and by the way, some of these deductions have been curtailed a little bit this year for meals and entertainment and incidentals. But for most people, you're not going to see a whole lot of difference. A meal with a client is going to generally be 50% deductible. So there's going to be some limitation. That's always been there. But let's say you're traveling. So you don't maybe have a client with you, but you're traveling to a conference, some kind of seminar, some kind of training. Now, let's say you take one of these trips, it's a week long, and it's pretty cheap where you're going, and you decide not to eat a whole lot. Maybe you pick up some groceries along the way. So you say $58 a day is a pretty good value. So 58 times 7, and 58 times 7, and we're looking at $406. Divide by 2, you get $203 as a deduction. Not bad, because maybe you only spent $50 for the whole week. But now the next time you take a trip, the next one, let's say another conference a few months later, all of a sudden that trip is a little more pricey. It's further away from reasonably priced dining options. And so what you do is you have a lot of out of pocket. And on that trip, you can specify that you're going to use actual expense. Now, you can't change within a trip, but you can have each trip being treated separately from another trip. Generally, if you're having a meal with a client and it's locally, there is no per diem. It's going to be actual expense. So that's one huge item that I see missed a lot. Office in the home is another one. People that have a small business sometimes forget to take the office in the home expenses, because Schedule A is a bigger issue now. The standard deduction is higher, and it's a lot harder to itemize unless you have an awful lot of charitable contributions, because salt taxes are limited to $10,000. And we're going to talk about that in a little bit. And charitable contributions, you can put up to 60% this year now of your AGI. And then, of course, mortgage interest would be another one. 2% miscellaneous deductions subject to 2% of AGI no longer count. They're gone. Some things like gambling expenses are still there. They're miscellaneous deductions, but they're not subject to 2%. And if you've got a really, really big medical pile of bills this year, those would also be potentially deductible if it exceeds a certain limit. So the office in the home is more important because you have a choice. If you have a small business, you can either take what's called a safe harbor, in which case you can take up to 300 square feet of your house as an office, and you get $5 per square foot, and you get to keep all the deductions on Schedule A where they are. If your expenses are less than that, good for you. You still get $5 per square foot times 300, up to 300 square feet. And like I said, it's a safe harbor. You just check a box in Form 8829. It just flows right through. However, because you might have bigger expenses this year, and because the value of the deduction on Schedule A is almost worthless for many people this year, getting some of the mortgage interest and the property taxes, especially property taxes, off of that Schedule A to Form 8829, which will flow through to your personal business, the Schedule C, makes an awful lot of sense this year for most people that are in that situation. I also talk about, I had a few notes here. I'm going to make sure you guys can see this there. I have right here, I have some what I call repair regs and tangible property. Really that those things get slipped down a little bit further, but I will touch on them right now because they do get missed a lot. And that is this: if you have rental properties, if you have a small business, almost anything that you're doing, individuals as well. Repair regs, for example, are this. This is if you have rental properties, for example, or if you have an office building. If you have a rental property and you put in a new bathroom or remodel a bathroom or a kitchen or some part of that building, you might spend quite a bit of money. And unfortunately, that gets depreciated over an extraordinarily long period of time. 27.5 years is the depreciation for most improvements to a residential property. Commercial is 39 years. If a repair an improvement is under $10,000, you can actually make an election telling the IRS, yes, I know it's a repair. Yes, I know it's an improvement. Yes, I know I should depreciate it over this side of forever, but I'm not going to do that. I would like to actually deduct that as a repair, and you can do that, and the IRS says, fine, we're happy with it, we're good to go. And I'm just going to, and when you see me, I'm just trying to see if I can have everybody. I can see actually some of the people and the names in here. And so let me see who we all have here. We had some reactions. Brian, Matt, Jenny, Debbie are on. That's excellent. And I have 14 viewers, and I'm sure that if I don't mess something up, I can kind of see most of the people. Next thing, tangible property rules. Now, this is also really good for small businesses and people that have rental properties. If you're thinking about getting rental properties, this could also tip the scale. In the past, prior to tangible property rules, basically everything was depreciable in a rental property. Section 179, which allows you to expense things, is not allowed inside of rental property. So even though you have a stove and refrigerator, it's in a rental property. Too bad, so sad, you can't deduct it under Section 179. Hey, how you guys doing? Love it. And if my audio screws up when I'm playing around with this, you guys yell fast and loud. Last time I didn't see it right away, so I'm watching now. And so tangible property rules allows you to deduct $2,500 of no matter what. So every tax return, whether you do your own or if you have an accountant doing your tax return, you make sure they check what's called the election for de minimis rules. It's the de minimis election. What this means is everything on that return, if you have a lot of rentals, if you have a Schedule C with a small business, if you have a small farm, maybe you're doing some, maybe some organic gardening or something and selling some things. When you check that box, everything on that return that is under $2,500 for those businesses are deductible versus capitalized, which means they get spread out over a long period of time. That cleans up your depreciation schedule on the first hand, and it allows you a bigger tax deduction on the second hand, which is really nice to have. So that has really simplified the environment for people that want to get into real estate. They're thinking of passive activities, and they would like to have some rental properties. And they say, and that's always the big question, if I'm going to make money on this, how am I going to deduct things? And if you buy a refrigerator, 10 years ago, you had to go over a number of years. And when you have a number of years to collect it, you're paying money out of your pocket right now today. Unfortunately, you wait 4 or 5, basically 5 years. And with 5-year property, it takes 6 years to depreciate it. So you get your tax break over a number of years for stoves and refrigerators. And of course, if you do improvements, it gets to be extraordinarily long periods of time. I'm actually going to jump into one more thing I'm going to add to the list here. In fact, I don't know if this is going to work real good, but what I'm going to do is, how am I going to add this in here? Improvements versus repairs. Again, a lot of people have questions about real estate because if you're in the FIRE community or you're looking to get some financial independence, maybe retire early, what you're really trying to do is get yourself into a situation where your investments are going to be doing a good job. Oh, we got, and David, I see you on there. I actually have some more things. I saw your question also on Facebook on the original post, so I'm going to be getting to your stuff as well too. But let's go back to improvements and repairs. Okay, people want to retire, they want to have some financial independence, whether you want to stay working, want to stay doing your job, regardless of what your choices are. Having real estate a lot of times is the ticket to get where you want to be. So you can have investments on one hand, but you may not want just the index funds. You may wish to have something that throws off a bigger income stream, and that's where rentals come into play. And the problem with rentals almost always is that big expenses can be really, really hard on the landlord. So let's say you have yourself a nice sized building and the roof goes bad. Okay, so the roof goes bad, you got to replace it, and you say, well, it's $30,000, and you say, well, that's okay. I get a $30,000 tax deduction, and I say, well, not really. Okay, it's over $10,000, so there we sit, no repair reg. But the question mark is, do I really get to deduct that? And the answer is you might be able to deduct that $30,000 roof in year one immediately. And here are some of the things you need to keep in mind. If you take off the old shingles of a roof and you put new shingles on, that is not an improvement. That is a repair. It is bringing the building back up to its original condition, its original value. Second, you have to be careful with the timing. The IRS says that if you do this in the first 5 years, you're improving the property. So if you buy a building and it's in bad shape and you say, well, I'm going to go out there and I'm going to go ahead and I'm going to replace this roof. Keith told me I can deduct this thing, shingles off, shingles on, no roof boards are being pulled up, but we're going to deduct this whole thing. Not in the first 5 years of ownership. Now, the second thing to remember is that if you, as the court, as I read it and understand it, you start pulling roof boards up, that is now an improvement. If it's just shingles off, shingles on, that is not an improvement. It's actually a repair, which is currently deductible. The same thing comes when it comes to windows. So when you take a window in my office building, if I have old windows out, new windows in, that is not an improvement, it's a repair. If I have to start playing with the sashes and pulling around under framing, that is an improvement. That is capitalized and depreciated over a number of years. I bring this up because even things like carpeting, and I understand that, and I've discussed this with auditors, and in fact, some people don't realize this, that in Northeast Wisconsin, one of the auditors for SCorp actually was my employee. So I understand some of these rules. I've talked with the auditors at length with this, and people will tell you, and many accountants will even say it, even the IRS will sometimes say it, is that you have carpeting in a rental property, you pull it out, you put in some new carpeting, that's going to be depreciable, and probably a 15-year property. Most rental properties, it doesn't last 15 years, so that's not a good deal. So what do? Well, I think most carpeting and most flooring, as long as it's the same thing, carpet out, carpet in, I believe that that's probably a deductible repair. It's bringing it up to its original value. I've actually in my office building, I actually went from carpeting to faux hardwood floors. And when I put them in, the auditor was in here for another matter with a client that I pulled in off the street, and I was doing the audit, and I said, I'm changing this carpet in here. It was here for a long time, here before I owned the thing. It really looks old and dated. It needs to be changed, and I'm going to put in this faux hardwood floor. And I said, what do you think about me deducting this thing? This was before the repair regs even. And I said, it's like $3,000, $4,000, $5,000 range. I said, I'm just going to write this thing off. And she goes, well, that's probably an improvement. And I said, well, I'm going to write it off anyway. What do you think? She said, we're not going to audit you. So the thing is, the IRS has become very open to understanding what a repair versus an improvement is. And when it comes to buildings, you can deduct a lot of things. That brings up a tax planning tip. If it is to your benefit on your tax return to deduct something and it's allowed, then you deduct it. If the IRS is also okay with you capitalizing this and they're kind of like shrugging their shoulders, they don't care which way you go, then if you don't have really any taxable income and your taxes are really low or you have no taxable income at all, it might not be a good idea to be deducting extra stuff because you can create an NOL, but it's not the perfect situation. Yes, Matt said he had a lot of luck with Drake software. I'm glad I got my new Drake software a few weeks ago, and that's good. And David Fox, best tax software for running different tax scenarios. And for David, I use Drake, and I've used it for a long time. In fact, I think my account number there is like 174 or something. It's really, really low. I'm one of the first people that went with them. And that is really, I've been always happy with it. It's a fairly easy to understand program, Drake software. So you had a lot of luck with Drake. Okay, great. And Rob, hi, how you doing? And what I'm going to do is, let me do this. I want to change some of these up as we go, so a way to look at some of this stuff. And so it's kind of a marker on the screen for you guys when you review it later. Now, when this whole thing is done, this is going to go up live immediately afterwards. Facebook presents it, and then you guys can review it. You can kind of tag where you want to go, including if you want to leave a note. Hey, this is something that's interesting. I need to come back to it. Maybe ask questions of your accountant. Maybe do a little research. Then, by all means, do the tagging, because I think that all sticks to the the file when it goes up on Facebook. Now I want to talk about some things that are deductions people miss, but basis issues. And I've been doing some consulting where this has come up a little bit. I generally do 2 consulting sessions every Tuesday and every Thursday, so four of these a week, and that's about the most I can do without wearing out, because it's quite demanding, the research as well as you're always on when you're doing these kind of things. So today I did 2 of them today, and now I'm doing this from 8 o'clock Central Time, and we'll probably be here, I would guess, to 9 to 10 o'clock somewhere in there doing this. They can take a lot out of me, so I limit to how many I do, but I run into this issue with inherited property. And as you might be aware, if you inherit something, and when you inherit it, if somebody died, mom and dad died, let's say you're going to get mom and dad's house. Well, mom and dad bought the house in 1954, and they paid $22,000 for it. It's now $400,000, and they've done a lot of repairs and maintenance over the years. Maybe they added an addition, all kinds of things. And so mom and dad die, and you say, well, we're going to sell the house and take care of that. But what about the taxes? And my response is, well, there's a step up in basis to the value on date of death. If you sell it within 9 months, generally it's assumed they're both the same price. There is no gain or loss on that. That's a pretty easy one. But sometimes it gets a little different. So right here with gifted property, this is a pretty serious issue, because there's a difference when we start doing some planning here. If you inherit property, that means that nothing's basically been done. It's sitting in the person's name. They die, you inherit it. Now, this can be, if it's cash, obviously the value hasn't changed. Cash is cash. If you have a car, or if you have heirlooms, or if you have a house, or if you have some land, all gets a step up or even possibly a step down in basis. The difference, though, things like annuities and IRAs, things like that, are a little bit different. There are required distributions for traditional retirement type products, and there is tax on that to the person receiving it. There is no step up in basis for those types of things. But gifted property is a little bit different. Sometimes what happens is mom and dad say, we want to give you the house and we want to turn this over to you, because if we turn it over to you now, it gives us that 5-year window before Medicare comes in. And if they end up in a nursing home, they don't want to lose the house. They don't want to have the spend down and all that kind of stuff. So they gift the property to the kids. So let's say this has happened for you. Well, there's a problem with that, because if you receive something in a gift, the biggest problem you have is you do not get a step up in basis. You get the basis of the person gifting you the house or the asset, and you get the basis is going to be their basis plus any gift tax paid. Well, the gift tax levels are so high right now that, except for the very wealthiest, we're not going to see a lot of gift taxes being paid. You might have to file a gift tax return, but there's not going to be a gift tax paid. So there is a planning tip there. Then there's something called life estate. These are these AB trusts, sometimes called I Love You Trust. This can help with some of this, and it contains what's called present interest and future interest. Mom and dad get to live in the house till they die, and then when mom and dad die, the future interest belongs to the kids. Now, that is a revocable trust, usually in most states, and it solves kind of the problem. But generally, the date that it is set up is when you kind of lock in the date of some of these assets. And again, it depends how these get written, because there's so many different types out there. But you can kind of lock in the value on date of death for basis. You can sometimes deal with, there's things, and again, I'm going to throw out some terms here. You don't need to know what they mean, and I'm not going to get into them because that would be a whole evening. But there's things like crummy trust. You can have intentionally defective grantor trusts, and I've run across some of those things lately, and they can be used very intelligently to protect assets. And literally, a defective grantor trust has its place. You intentionally write a trust that is defective. So maybe someday, if there's enough demand, I might even do a post on that kind of thing. And hey, Brian is here. Hello, Brian. How you doing? And now I want to talk about one other thing, and this is something that is missed. Man, I see other accountants missing this. This really drives me nuts, because I was doing a consulting session today, and I just told the guy, I said, if you shut your business down and you decide to retire, you got some big tax deductions here that are just kind of hanging up in there, and nobody told you about this. And this is where it comes in. you have a small business, maybe you have a side gig, and you've been reading my blog, maybe you read Mr. Money Mustache and you heard about turning into an S corporation and that kind of thing. And okay, I'm good with that. So you got this S corporation and you put some money in over the years, and maybe it's a kind of a cash cow, keeps on throwing out cash. You don't have any loans. That's a simple calculation for us here tonight. But when you take the S corporation and you finally get to the end and you say, I'm going to sell it, or I'm just going to shut it down. It's not really sellable. It's the kind of business that's not going to bring any money, but I'm just going to kind of wind it down and retire. It doesn't mean when you sell the last of the inventory, you go like this, do the last tax return and walk away, because there's still basis there. So let's say you have $50,000 in basis in your S corporation. It can be an LLC treated as an S corporation. It can be a straight corporation. It can be, anything like that. And you have $50,000 of basis. Well, this is money that has not been returned to you. And if you clean up the whole business, sell the last assets, the last inventory, and all that's left is $10,000 because this basis is just hanging up there. Maybe some inventory was devalued, something like that. That $40,000 of basis is basically deemed part of the sale. You sold the last $10,000 worth of stuff, and now you have a $50,000 basis that needs to be cleaned out. Generally, you take the loss of $10,000, reduces the basis to $40,000, and then you effectively have sold your corporation for zero, and that $40,000 now becomes a deduction, which if it's 1244 stock, which in many cases it is, Section 1244 stock is deductible up to $50,000 per person per year, and that can be kind of a nice little deduction. And if you don't know it's there, you just walk away from it, and that's kind of crazy if you don't want to be seeing that kind of thing. The other thing that I want to talk about with basis issues, again, and I harp on this because it's the one area I see where it's not a missed deduction, but it's a real big problem. And I'm going to put this down here for a second so you can look at me, and because I'm like that, I like to be seen. Super interested in this topic of a parent's house. If you have any other concerns or anything you want to share, realize it is a public live event. But if you want, or if you send me a private message at some point, I can see if I can answer things. Dealing with the parent's house, there are so many issues. Where you live, your state is going to be a huge, huge, huge issue. State laws are different. So I go and tell people what I think from a tax standpoint, and I'm going to be generally pretty correct. And I say that tongue in cheek a little bit because nobody should be so arrogant when they're doing taxes that they think they know everything. If you do, you'll be humbled very quickly. If with the parent's house, it's not just the gifting issues and the transfer of ownership, it is that Medicare planning. I'm not going to get into this tonight, but I have a blog post that I'm working on, and the only reason why it's not published is I need to do a lot more work to make sure I get this correct. Because if I'm going to talk about this to a public group in a public forum, I better get my facts straight. And what they're called is Medicare compliant annuities. And it allows you, I believe, and I'm crossing T's and dotting I's, where you don't necessarily have to have that 5-year window. So it doesn't work for everybody, but I'm certainly working on that process. One of the best people presenting those annuities actually is in Green Bay, which is about an hour north of me. And because other attorneys around the country come to him for this kind of stuff, I'm going to be actually discussing more detail with him as well too. So if there's anything that you want to get more in depth with, Sarah and anybody else interested with this, I am certainly Kathy's waiting for that blog post. I have several blog posts now. I had a blog post I was getting a little lazy. It's getting to be Christmas, and I had this idea. I was going to do a blog post on conservation easements, which would be an incredible tax savings tool. Unfortunately, it's an area that has a lot of fraud, so I'm going to have to do all my research before I tell you guys to do it. And as I was writing it Saturday night and into Sunday, I realized very quickly I need more research before I can tell you guys. So I had to pull the plug and write a post Monday night, because I didn't publish on Monday, which I normally do. So I went ahead and I just didn't publish. It just couldn't be done. It wasn't going to be right. I can't do it. I have to be dedicated to the quality. It has to be on top or it's not going to happen. So I wrote a pretty good post on something that has a narrow niche, and that is if you have gambling losses, how you would deduct them and how you can get around certain rules like itemizing, things like that. But let's go back to basis issues. Let me bring this back up here again. I'll kind of mix it up a little bit so you guys can see things and the screen moves a little bit. But SCorps here, we're right here now with this part right here. And the reason why I want to bring this part up as part of this issue of deductions people missed is I'm more concerned about SCorp. So a lot of you guys have small businesses. Maybe you have a side gig. Got a side hustle going, and you've been reading some of these blog posts. And you say, God, I want to get me one of them SCorps. Keith said I could save a lot of money, and the odds are pretty good. If you're making $30,000 to $50,000 a year, an SCorp starts to become viable, and once you go over $50,000, it becomes very viable. In fact, you're going to feel a lot of pain if you don't do it. So the problem with an S-Corp, though, the one thing that people need to be aware of is an S-Corp can borrow money, but never, ever, ever, ever should. The only person an S-Corp should borrow money from is you. If the S-Corp needs a loan, the S-Corp should not get the loan and you guarantee it. It doesn't add to your basis, and if you ever have a loss in the future, could cause catastrophic tax problems. On the other hand, if you borrow the money, virtually guaranteeing it, right, because it's to you, and the corporation then borrows the money from you, and the corporation can guarantee the loan if they want that you have, that does increase your basis. And if you ever have an S-Corp and you ever borrow money, the S-Corp has a line of credit or something, shoot me a line or something, or give me a holler, talk to an accountant. They will be, your attorney, anybody is going to be screaming and hollering and jumping up and down that you should not absolutely, beyond a shadow of a doubt, ever have an S-Corporation get a loan, because there can be huge, huge problems on that. The next area when we talk about deductions people miss is realistically, and I see this so often, guys come in and they're late. They had, sometimes they're a year or so behind. Sometimes they aren't. They just bring their stuff in and they bring in a shoebox. And some of these small business guys bring in rather large shoeboxes. And the problem I have with that is when I'm doing the work of putting these things together, understand how an accountant does this. If you bring me in a box of receipts, I'm going to bring in some intern or some basically very entry-level individual. I'm going to say, there's the conference room. I want you to take all these receipts, put it into piles of what you think is best. Then run a Z-tape. A Z-tape, if you don't know what that is one of these little guys. It's just a calculator, and the computer, what it does is it goes with the numbers, and it comes like a Z, and it keeps on going down the line. So I'll run a Z-tape on it. I'll take that paper that has all the number on it, the Z's, and I will put it on top, staple it together, add it in the return. That's it. I don't audit the return. I don't have time to audit the return. No accountant does during tax season. And we're going to make estimates or guesses on what you're doing, and we're probably not going to get it right. And this for good reason. We don't know your situation the way you do. That, and when you put it in a box, if I can't read it, the answer is 0. It's up to you to give the accountant good numbers. For one thing, even you're in a bad situation. Looking at your own receipts a year ago, I tell you one thing, it's really nice to have it in order or somehow accounted for, because then if the receipt looks bad and someday there would be an audit, you say, well, I can't read the receipt. But at the time, contemporaneously in tax code, there was a contemporaneous recording of that dollar amount. So this might not be very clear, but this is, and therefore we get the deduction. And what CPAs and enrolled agents should be telling you when it comes to taxes, it's form over substance. If your form's in order, you will win, even when in many cases you might not have substantial grounds for a deduction. So form always wins. And even if you are correct and deserve a deduction, you can lose it because your form was not in order. Professional development. This is one here that I deduct a lot of this, and I see it being missed a lot. Professional development, and we're going to go to the top of this page here, also includes like training and books. I deduct virtually every book I read. And the reason why I deduct every book I read in my business is because as a business owner, I'm already doing an awful lot of things. I'm reading generally things that are involved with business. Now, it may not be a business book. So, for example, I'm reading Enlightenment Now. I got about 100 pages left, a little less than that. And it's about progress, science, and things like that. Certainly, as far as I'm concerned, is a business type of book, because it talks about how progress is moving forward in our society, in our world, and has been for a long time. And by understanding that, it can help me run a better business and that kind of thing. I got a book here even today, came in the mail, Maps of Meaning by Jordan Peterson. This is a pretty in-depth book. It's a pretty expensive book, and I've been kind of paging through it today, and it's gonna make my head hurt because it's really good material. But those books, you might say, well, they're not business related, but if they help me learn how to interact with other people better. I even deduct some novels, for example. I read a book, Tom Wolfe, A Man in Full. It was a book that had strong undertones of stoicism. Well, this is the kind of thing that you need to learn, to understand, to think about if you're going to be a better business person. So if you have a side gig, if you have a side hustle, if you have some of these things going on, you can deduct these types of things. So that's also a deduct. And training, by the way, too. People take training classes and they don't deduct it. If you have a side hustle and you're going to FinCon, and I mean, if there's anything at all, if you're dealing with personal finance, if you're writing a blog in this demographic, if you're an accountant, okay, I'm an accountant, I go to FinCon. Even if I didn't have a blog, I would still deduct it. And the reason for it's quite simple. I think it's a deduction. I think it's not even a hard argument. Gambling losses and sessions. I'm just going to tell you, read the blog post. I will put some of these links at the end of this presentation. I'm going to drop some links in this thing so you can review some of this. Gambling sessions. If you do some gambling casually, it can be a real big problem. It's getting worse because of the tax law changes and because the standard deduction is higher. But if you want to deduct things up front, be aware that if you have a gambling win, you go to a conference, maybe it's at a casino someplace, so you drop $20 and you win $3,000. That could be enough to make you pay more in your healthcare premiums. If you have an income that's below $50,000, it could harm how much you get for an earned income credit. It could hurt your child tax credit. It could hurt education credits. By understanding sessions, you could actually put yourself in a much better position. So, Matt just finished 12 rules. I think it is great. Well, I'll tell you, when I finish Maps of Meaning, I'll let you guys know, and I'll write a blog post on it. But I got to tell you, 12 Rules was an excellent book, and it's one of them books that took me a while to read. And I even wrote one blog post on something that I thought was affected the fire community a little bit, and I caught a lot of heck for that. This Maps of Meaning, I'm just going to kind of put this up here. You'd think a book like this, that type is just unreal small, but like I said, this is really digging deep into what makes people people. Dr. Peterson actually made the comment I saw a while back where he said this is out in audio version now, and he said he thinks the audio version is better because how you read and the inflection of voice makes a difference in some of this stuff. I'm more of a reader than an audiobook listener, but I think there are some there's real good information in there, but I might be reading that book slow, but I'll certainly share my prognosis on that. So if you hear of a crazy accountant that had a hemorrhage over the Christmas holiday, I had a little free time. I'm sorry, I couldn't help myself. I opened up Maps of Meaning. Terry has started brand new sole prop in 2018. Losses only so far. Trying to find guidance. What are the rules to establish this as a business versus hobby? That's a good question. Normally, I like to see things as a business versus a hobby. And here's the reason why. In your case, it's a loss. If you're doing this with the intent to make a profit, I'm going to argue that, yeah, you don't have a profit now, but you have some losses. If you treat it as a hobby, all the income, not the net, all the gross income. So you might have $10,000 in income and $12,000 in expenses. You put the $10,000 on page on 1040 and pay tax on it. You get no deductions for the expenses. If you show a profit in 3 of any 5-year period, the IRS is going to come back and say, "No, Dice, I'm sorry, you can't do it," and they're going to turn you into a sole proprietorship anyway and tax you accordingly. I actually wrote a blog post. I'll have to look it up. It's going to be hobby versus small business or something like that. So if you Google that, if you Google the wealthy accountant, hobby versus business, it should be the top choice from Google. In fact, let me do this. I might be able to pull something up here. And hobby versus business. Oh, here we go. So I called it pays to have a hobby. And I'll bring this over to the other screen real quick here for you guys. And hopefully you can see that. So what it's going to do is this, and again, you look this up, and it's going to talk about some of the things, business versus hobby, some of the things to be concerned about, some of the problems. Some of the elections that can be made, fairly in depth, I think. And again, you can read that at your leisure, but that's going to give you kind of a starting point. A hobby can save you money if you do something. Let's say you do something periodically, or you're only going to do it for a couple of years. And this is where I think Uber drivers, they do it for 6 months or a year and they quit and then they're done. I argue strongly that they're not a business. They had an intent to make a profit, they say, but I say, wait a minute, you did this part-time, you bought a $30,000 car, that's what you're using this for. So you got a $30,000 car, you made yourself a quick $4,000 or $5,000, you got all these expenses, you got self-employment tax, you stayed doing it for 6 months. Really, if that's what you intended to have a business, it was a pretty bad one. I argue you did it to make a little side money as a hobby, and I think I'd win that argument everywhere from the IRS down to SCorp. You're welcome, Terry, on that. So again, the difference between a hobby or where a hobby can save money. A hobby can save you money if it has a profit. So let's say you have a profit. Let's say you do something on the side. Let's say you do model ships inside of a big glass jar, and it takes you years to get the thing done, but when you're done, you sell them for $40,000. Well, you're not going to show a profit 2 or 3 of every 5 years because you can't. You're only going to do one of these every 5 years, so you're going to get one sale every 5 years, make $40,000. What is that? That's a hobby, and therefore you would avoid self-employment tax, which would be about $6,000 in taxes. So that would be where I would like to see the hobby rules applied. Now we want to go into the next section here a little bit, and this is on lowering your adjusted gross income. And here's why this is so important. Adjusted gross income affects so many things, and if you allow your AGI to get too high, and if you don't use things to reduce it, everything from the premium tax credit can make your health insurance premiums higher. You can have, or an income credit can be reduced or eliminated. The Section 199A issues that apply to landlords as well as small businesses could be an issue. Child tax credit can be an issue. I'll bring this back here for you guys. I think you'd like to see that. And this is what I have right here. Passive activity rules, AMT, passive activity rules. So you have a rental property that shows a loss, you can deduct $25,000 per year, up to $25,000 per year against other income. So that may sound like a great idea. Say, okay, well, I'm going to deduct this, but it phases out between $100,000 and $150,000. So basically, for every $2,000 you are above $100,000, you lose $1,000 of the $25,000 cap, which you can deduct. That doesn't apply if you're a real estate professional, but for everybody else, we're going to be limited to this $25,000. So if you have, if your income is, let's say, $110,000, and you have use some of these tangible property rules and repair regs, and now you did some remodeling on this building and you got a bunch of deductions, it'd certainly be nice to take those deductions. And so far you said, but Keith said, I can take tangible property rules and deduct it. You can. Repair regs, follow those rules. I want to do it. This is a repair, not a maintenance or not an improvement. Okay, we're going to deduct that. Wonderful. We got this big deduction this year. And then I say, oh, yeah, but you see, your income is up there. Your income's $150,000. You get nothing. We'll suspend that and hold that for a future time. That irritates people. However, here's some of the solution. We have lowering AGI. Itemizing doesn't help, but we're going to keep this in mind here. Oh, by the way, this is something also happens too. If you have if your AGI is just a little bit too high, it might reduce or eliminate the ability to put money into a Roth or a traditional IRA. Lowering the AGI. Itemizing doesn't help. It must be above the line. Businesses and landlords need to max out deductions. We've talked a little bit about that. We want to make sure every deduction that a landlord or a business has, that they get a deduction on it, even if it's a non-cash deduction like per diems. And that's going to end up really on top of the 1040 is where it's going to flow through. And it's what's called above the line. And above the line means that it's going to affect AGI. Deductions and losses will drive that number down. And that becomes very important because the biggest thing today is this stuff right down here. This thing did this to me too, didn't it? The autocorrect on these things take HSAs and turn them into the word has for some reason. But the best way to lower your AGI is with a couple of things. So first of all, you got to get your business and rental income down as much as you can. Maximizing retirement plans. If you have a 401k at work, maximizing that out takes it off of box 1 of W-2, never shows up on your 1040. If you have a small business, oh, by the way, and the matching doesn't show up anywhere, not even on the W-2, and it's actually FICA tax free as well. It's just going to be income tax deferral is what it's going to be. If you have your own business or side gig, and you do some of this massive matching with profit sharing, you can say, I'm going to pay myself $40,000 per year. Good. And you can take a $25,000 matching, basically, or profit sharing, and you can deduct that. That is a deduction for the business, goes right into your retirement account, and it never shows up on your tax return, effectively driving down your adjusted gross income. Student loan interest, should you have that, that's maxed out at $2,500 per year. That is also going to drive AGI. By the way, a lot of these are adjusted gross income, adjustments to income. The retirement plans are above the line. That's good. HSAs, if it's available, or if you have self-employment health insurance premiums, that also would come into play. Retirement plans. Now, I'm dealing with last year and the upcoming year, so I have to keep on looking at my charts as I'm telling people. But we can get. It used to be $54,000. It's now up to $55,000. I believe they raised that for 2019 already, and I thought it was like $19,000 a year and 56, or is it? Yeah, 56,000 is the max. But there's a whole combination of things here. Don't automatically jump to thinking a 401k in your own business, a solo 401k, is the correct answer. I did a consult recently here, and I looked at his stuff, and I told him, he had a small side gig as a sole proprietorship, and he was doing a solo 401k. And I said, yeah, but a simple IRA would actually be better. You'd actually be able to deduct more. So don't lock yourself in. I'm not going to go through each one of these, what they mean. I don't think that that you need to hear that. I've written about it pretty extensively on the blog, and if you have questions, I certainly can be. Let's see here. And David is saying modified adjusted gross income and adjusted gross income being used interchangeably. I shouldn't do that. Adjusted gross income is that line, and let me see if I can pull this up here for you guys. These are test returns inside the 2018 program. You can have adjustments to income. This is going to be your adjustments to income, and they're going to end up going, I believe, on Schedule 1 this year. They're not on the 1040. They go on Schedule 1, looks like the 1040, and then it just flows to the return. Modified adjusted gross income can include certain items because, for example, Social Security, if your income is higher, can be more taxed. So that's where gambling sessions come in. Can we do things with retirement accounts maybe and bring that down? Modified adjusted gross income. I'm mixing the metaphors, so to speak, or mixing the terms in this case, because we can go into all the calculations and we start to get into a problem getting into, I think we're going to bog down in that. I wanted to cover a lot of stuff, but yes, modified adjusted gross income is going to bring certain things into play here. But things like retirement accounts are going to affect the adjusted gross income because it's going to reduce the income period. The matching is going to do that as well. If we come up with our thing here, what I have in here, HSAs, these are adjustments to income. Those certain things, for example, modified adjusted gross income is going to draw in most cases. It's going to draw in things like municipal bond interest, tax-free bond interest in many cases. That's another whole discussion. We can maybe deal with that another day, but getting down to MEGI and AGI, we can have a lot of fun with that. But here's one that's really affected a lot of people. I know this has been asked about a lot. And by the way, David, I did get your message about buying a primary residence, and I will. And TJ also had something. I don't know if he's in the crowd tonight, but he asked a question too. And what I'm going to do is answer those questions as well. But I'm going to kind of go through these in order. Some of it will be answered already. This is the biggie, and I'm not going to BS any of you guys. This is not going to be where I come up with some magical solution and everybody's going to be all better. High tax states, that includes California, Oregon, Massachusetts, New Jersey, New York. Connecticut's a high tax state, but sometimes people don't realize another high tax state is Texas. Wisconsin is like number 8 or 9 for the highest tax state, and I think Texas is number 11. Texas has no income tax, but they have a really high sales tax, and they have a really high property tax. And again, those are still SALT taxes. SALT taxes are it's state and local taxes. So that's going to be local taxes are your property taxes. State taxes are going to be income taxes or your sales taxes. Some sales taxes, like in Wisconsin, they can be local as well. But those taxes are limited to $10,000 per tax return. Let's see if I can come up with the SALT solutions. I'm just going to put this up here so you guys have a marker when if you're scrolling through this in the future. Schedule A is a very dirty animal right now. I think almost, unless you have a big mortgage or if you give a lot of money to charity, you really, really don't have much left on the tax return. If you're a married person, you're allowed $10,000. If you're a married person, you get a $24,000 standard deduction. You probably don't have any medical expenses because medical needs to be this big, huge number before it counts. You're probably covered through some kind of insurance. You get $10,000 max for SALT. You get mortgage interest. You get charitable contributions, and then you get miscellaneous itemized deductions, not subject to 2%. There's some things in there like repayments, things like that come in under that heading, under this miscellaneous. Gambling goes in there. But the reality is, if you only get $10,000 for SALT tax, for SALT or the state and local taxes, and you have $24,000 for your standard deduction, you're going to have to give $14,000 to the bank in interest and or to a charity. And only after that do you have any benefit. That makes it a lot harder. So what I have here is I say, let's dump this Schedule A. I'm not saying you shouldn't use it. I'm just saying that Schedule A is not going to be used as much this year, and I would not hang my hat on trying to fix the SALT problem by going to Schedule A. You can't fix it there. It has to be fixed someplace else. We have to find ways to get things that would normally have been on the Schedule A in the past. We got to find another place to put it. We are not going to have a perfect solution. So I'm going to give you a bunch of solutions, and none of these are going to be completely satisfying to every single person hearing this. Listen to each one, think about them, see which ones apply to you. I'm sure I've missed many other strategies that can be used. And hopefully it jogs something for each and every one of you. The first one here we're going to touch on for Schedule A and these SALT tax issues. If you're especially on the bubble, so to speak. So let's say you have $10,000 or more in state and local taxes, so you're maxed at 10,000, but you've been following the fire community, your mortgage is pretty low or gone, and you do give some money to charity, but if you give $14,000 to charity and you don't have a mortgage, you don't get a deduction. You get 24,000, whether you itemize or standard deduction. So you have to give more than 14,000. You can shift charitable contributions, and I'm working on this. I have a person actually that is he's an actor for one of the I guess network television. I don't watch TV, so I'm not real good with this, but he's I guess a fairly famous actor, and so he came to me, and we're dealing with some of these issues. We're dealing with how you can give money to charity without putting it on Schedule A. So if you're not going to get any benefit from having Schedule A, then why not get a deduction for things that are there someplace else? Rob says, I live in California. I am full-time repo. I just converted my primary to a full-time rental for 2018 after discovering fire and salt limits in the new code. I can touch on that a little bit, and if you want to clarify, if you have any concerns with that Rob, I can certainly give you some ideas of how we're going to work with some of this. And I'm also going to have a real estate part here for 5 or 10 minutes, 15 minutes as well, where we can talk about how to use real estate in a very proactive way. Shifting contributions to charity for promotional expenses for business. This works for people. If you're a real estate agent, if you have a side gig, a side hustle, you have a small business, even if you have rental properties, this might work on a limited scale. And here's what we're going to do. We're going to let's use my business for an example. Okay, I have Tax Prep and Accounting Services Incorporated. That is my company, my business. Now, I give money every year to a local event where that takes place over the 4th of July, and it's for all it's the celebration for Independence Day. It has a lot of events, has fireworks, and businesses can put money into that. Well, they take my name and they put it up on a sign. I don't think I ever get a client out of it. It's my way of putting it out there, though, and it's a promotional expense. I gave to a charity. Yes, if I wasn't a business, it goes on Schedule A, but I am a business. And if you have quite a few rental properties, I would argue that if you have 10 rental properties in your locality, you probably have a business name for that. And I would argue that the goodwill generated from that could be valuable as well. But certainly for a business, donating money to those kinds of things, take it off of Schedule A, move it into the business return, whether it's Schedule C or the SCorp, the 1120S. Keep in mind the next thing. This can become rather large. Promotional expenses. So for people, let's say you have a religious background. I'm not saying you have to. I don't get into that conversation, but let's say you want to give money to your church. So if you give money in the plate on Sunday, and I have people that they come from the Dave Ramsey crowd. They're very strong at tithing, and I'm a firm advocate if they want to do that. I want to help them do that. But if they want to give as much money to charity as possible, then I can help them save more taxes so that they can give more money to the charities they like. So let's go ahead and use an example of a local church. Oh, now I got a Pinterest account, guys. And I use marketing for that too for my blog. So putting money in the plate on Sunday is really going to be on Schedule A. That's it. However, if you sponsor something, so maybe you have a nonprofit that you want to sponsor something for an event, that is going to be a promotional expense because you're going to be a sponsor of it. They're going to put your name up there saying so-and-so gave X amount of dollars, and that is your marketing expense, your advertising expense. In this case, we're talking about a 7-figure contribution to a church. And so we had this powwow session where we talked for a couple of hours. I talked to this actor and I said, I think that we can get you the deduction. He wanted the 7-figure deduction. I said, let's talk about what the church is doing. And I discovered they're doing this addition to the church. They're doing some a huge project, needs a lot of money. And I said, okay, let's get this done before the end of the year. And I'm working on this now. We're going to try to get this done before this year end. And we're talking about an incredible deduction. And this is going to be a business expense because it's promoting his career. And it's going to, he's going to be moving from where he's at to maybe a different type of schedule and a different type of acting roles he wants to improve his position. Well, of course, you need to be doing some things. Now, promoting your program, creating this goodwill, makes a difference sometimes between if a casting director or a director of a movie wants to work with you or not. Somebody that is philanthropic could be making a very big contribution, not only to the organization, but to their own career. So we're structuring this, and I want you to think along those lines. Whether you have a side gig, side hustle, a small business, even with rentals, I'd be a little more cautious. I got a piece of dust came on my glasses, but just found it interesting. Okay, so 1 second here. I want to make sure I get. Sarah said, "Can you add together all of your property taxes? We own 3 houses in Texas, Austin, and do those go on different forms?" Well, yes. Let's do this, Sarah. And I saw yours as well, Rob. We'll touch that in a second. For Sarah, are these 3 houses personal or are they rentals? If they're all personal properties, ooh, that's bad. Because the answer is yes. Because what happens is the interest, if they're personal properties, probably would be deductible, but there's a lot of limitations on that now. There used to be $1 million limit. That's now limited to $750,000 of mortgage on primary ownership, second homes, and we can get into some long details on this. If they're rental properties, they're all going to be. If you have 3 rental properties in 3 different states, you're going to deduct all those property taxes on Schedule E with that, and it's 100% deductible every time. The only limits you'll have is passive activity rules, and if for some reason you suspended a loss, it only suspends it. You either get it in the future when there's a gain, or when you sell the property. It doesn't matter what passive activity rules say. You take that deduction at that time. But 2 rentals, 1 personal. The 2 rentals are going to be on Schedule E, and you will be deducting those property taxes and any mortgage interest, including any other taxes connected to those rental properties, will be deductible in full. We're only going to be worrying, Sarah, about the personal residence, that property taxes, and here's the other one. If you have a W-2 paycheck or any state taxes paid, heck, if you have a halfway decent income and you live in Oregon where they have like 9.75% tax or 9.5% income tax, you don't need to make very much money to have to make an estimated payment or to have withholding from your check. Boy, you get to that 10,000 mighty quick. So the question the thing that my response is, the rentals are great. That is going to be fully deductible. Don't worry about salt taxes there. Always have been deductible, always will be, unless it really gets insane. It's that personal residence which is going to be limited. So 2 out of 3 isn't bad, I guess, but that's not a satisfying answer either. But the good news is 2 of those properties will not see any curtailment in that deduction. For Rob, just found it interesting that the new tax code incentivizes real estate brokers to convert their house to a rental if it is $1 million and rent the identical house next door. Depreciation write-off for all properties and no limit, and interest over the new limit on debt. Yes, that is. There are so many things with this tax code that are going to have to be clarified. How did I get? I go to Tax Insight. I take a lot of continuing education classes, but Tax Insight is my favorite because they're one of the most well put together. And what did the instructor say? He retired now from his business a year or 2 ago, and he's doing the full time just the speaking. And he has like 30 years experience. So he's got like the number of years experience as I do. And he goes, when you get a big tax law change, the first year we guess, the second year we kind of know what we're doing. By the 3rd year that we do tax returns with it, the court's kind of figured out and the IRS has figured out what we're going to do. And unfortunately, I think there's a lot of planning tools. I think that, boy, I tell you, here in California, you're all screaming over there, and for good reason. If you reclassified or recharacterized how you taxed, it's not that the lower tax states have lower taxes. In some cases they do, but California has unique situations that it's going to require. It's almost like a country unto its own. So therefore, it's going to have these higher taxes because it just has a higher population, a bigger issue. Turning a primary residence, convert their house into a rental. and it's all a catch-22. It's a double-edged sword. There's Section 121 exclusions that come into play. So let's say you have a rental property, and let's say high-end houses. So $1 million houses are not that rare in California, whereas by me they're just almost unheard of. But let's say you bought $1 million house, and of course now all these SALT taxes come in, because if you have a mortgage, even at today's low interest rates, right past 10,000, like you're standing still. So you go ahead and you turn it into rentals, you play little games doing that kind of stuff. But you buy the building for $1 million, and let's say a married couple again, and a few years later, real estate has been great these last couple of years, it's worth $1.5 million. Well, okay, what are the rules? Well, if it's a rental property, you pay tax on that $500,000. We'll get to some ways to get around that in a little bit, but you pay tax on the $500,000. Well, that's not very nice. If you owned it and lived there 2 of the last 5 years, then you get what's called a 121 exclusion, and you can exclude up to $250,000 per person. So in my example, for a married couple living there 2 of the last 5 years, they would have a $500,000 of tax-free money. So yes, some of these nuances in the code, like the $750,000 limit, turn it into a rental, get bigger deductions, because otherwise you can't. You're going to be capped. And I would get into some of the math and that $750,000 and how you can do this with a second home and things like that. That would be kind of beyond the scope of this. We'd have to have just a narrowly niched 1-hour presentation for that. But certainly there are some planning tips around that. It might even be worth something being specific just to your own case, what you're doing, because facts and circumstances just rule the day when you deal with these things. And the new tax code is clear on some things, and on the things that it is not clear on, we have to make educated guesses, and we always want to be doing that. We want to be making intelligent guesses. We don't want to invite an audit. Even if you win, it's still no fun. So the next thing with SALT issues, mortgage interest, office in the home. Those two I'm going to kind of put together. The mortgage interest, again, kind of what Rob is saying, I would rather, so you buy a rental property, I would rather you borrow on a rental property, even if you have the cash, right up to the hilt and pay off your personal residence. Why? Because that rental property over there is going to get a deduction and all that interest, regardless of the cost of it, regardless of the size of the loan, because it could be a duplex for whatever price it is. It could be a multi-unit building for $10, $15 million. I don't want people to have a loan in their house, and if I can shift that someplace. And you have to be careful. You just can't. There's something called interest tracing, and we're not going to get deep into that either. But we just can't go out there and play little games and make it work quite that slick. But we can say, I'm going to do that over there, and when I do that over there, I'm going to mortgage that sucker to the hilt. I'm going to borrow. Maybe I have a business. I'm going to borrow to the hilt with that, and I'm going to use that borrowing. And instead of taking the cash, because I have the cash, but I'm going to borrow over there anyway, and I'm going to use that to pay off my mortgage. And by doing that, you beat the Schedule A little bit. First of all, though, you have to be close to the limit where you're not going to be itemizing anymore for this to work. Otherwise, it's kind of just moving numbers around and you don't get much. Or you have to have some limits on your mortgages, because the mortgage is very high. New York, especially New York City, and a good portion of the West Coast, Seattle, probably Portland has some issues with this. California is, man, it's got that. That's just. What did you say? Yes, yes, that's what I said. That's what I said, Sarah, with a little bit of a tongue in cheek here. If I can go out there and get away with this, let me make sure I say this correctly, because this is not. I got to be careful how I say this, because you guys are going to go out there and do this stuff and save money, and I want to make sure this is correct. If you come up to me and say, Keith, I have this SALT tax issue on my tax return, I'm itemizing $30,000 on my tax return. $20,000 comes from mortgage interest, $10,000 comes from SALT taxes, which are capped. And I say, wonderful. I don't want you to have a mortgage on your house. I'd rather the money come from the rental properties, and then you have the cash, pay off your primary residence. Now you get a standard deduction, but you deduct all the interest on that rental property. Now, we have to be careful that we're not trying to shift income. And if you want, we can, great. understand the income tracing rules. If you're doing your own taxes, you might want to look this up. I have an income tracing post for my blog in the queue, and it's been there for probably 6 months to a year. I really should go through income tracing, especially with some of this stuff. That is such a powerful tool this year. It is just unfreaking believable how valuable that is, because when you're dealing with salt taxes, with Schedule A, and especially if you're in a high tax state, which basically is 30 of them, 30 to 40 states are dealing with salt tax issues. Yeah, you got to think outside the box with this and get that off that Schedule A. It only works if you have some other source. So, I mean, having a rental property, and I agree with that, Sarah. I think you're going to love that to go do it. Now, 18 is already over, but 2019 is coming up. Getting some of that switched might. Sorry. We'll have a discussion on this, Sarah. So, okay. And in fact, I don't have any more appointments available this month, but if you want to talk about this income shifting, let's do that in January, Sarah. So, okay, we're good. The next thing, office in the home. If you have a small business, even if you have rental properties, you can have an office in the home. If you take the safe harbor, that's fine. But let's say the safe harbor is not enough, because the safe harbor is capped at $1,500 a year. Let's do this. If you have an office in the home for a small business, you can take actual expense. So let's say 20% of your home is being used for an office, then 20% of your property taxes, 20% of your home insurance, 20% of I'm sorry, Sarah. I know I'm stutter-stepping here. It's like, whoops, I'm sorry. I didn't say that. I might be an accountant, but well, we have memory issues sometimes too. So I hope Sarah's laughing. Okay, perfect. I love it. The office in the home is a way of shifting property taxes and interest and things like that. Now, keep in mind, remember when I said about getting the rentals, let's get the interest over there? That's a pretty good strategy. I like that. But it doesn't help with the salt taxes if they're really, really high. So an office in the home doesn't matter if you pay the salt tax, and we can get an office in the home. Any amount you take from that category, because it's already capped at $10,000, it's just more of that expense that you can deduct. So if you're able to do it, if you have a side gig, small business, keep in mind the office in the home rules read regular and exclusive. What that means is you can't have a corner of the living room as the deductible office in the home. You can't have part of the garage. It has to be regular, which means it's being used on a consistent basis for business, and exclusive. It's used for nothing else. A spare bedroom would certainly fit into that. 25, 30 years ago when I had my office in the basement, that would also be included in that. So you would have, you would have that deduction. So here's one last thing. This is one thing I want to talk about. This last thing right here, and then we'll move on from salt taxes. I think a good planning tip today for most people is to delay paying anything that's on Schedule A as much as possible. Now, let me pull this down for a second so you can just look at my lovely unshaven face. I'm going to let my hair grow a little bit there. I think that this salt tax issue is temporary. I think we got another 2 years of this maybe, and I think that it's going to be changed. I think the next time the economy has a hiccup or slows down, it's going to be the only way to push it. If you don't push the big states tend to be the high tax states. If you don't take New York and California, how are you going to push the economy? California is 20% of the U.S. economy, for crying out loud. That is an issue. So I think it's temporary. I think that, and because of that, anytime you can't use a deduction, the longer you take to pay it, the better. So, for example, let's assume that the possibility exists that this tax law change is not going to stick around forever. So salt is not going to be a problem. You can delay two ways. One, property tax payments right here can be paid in 2019 instead of 2018. So if you have $10,000 or more of state income tax withheld in your W-2, or you made estimated payments, you're already at $10,000. Why pay the property tax? Pay it next year, and hopefully at some point you push this out into the future and you win. Okay, you preserve some of that for a future day. Another, and this is a really, really minor thing, but I'm just one of these guys that minor things can make a difference. Let's say you have a mortgage and the payment's $1,000 a month, of which, I don't know, $800 is the interest. It's the first year you bought the house. So when you pay your December payment, make that last payment in the new year. So your December payment might be due December 1st. January 1st is the next payment. Don't pay it early. Make sure you keep on sliding that into the next year. And technically what you can do is you can kind of have 13 months in 1 year. Oh, I agree with you, Jane. I agree with you 100%. That 10K cap on SALT is nothing but politics. And I won't get into it because that's not what we're here for. We're here to try to solve problems with the environment that we have. But the SALT tax is really I like many of the tax code changes with the Tax Cut and Jobs Act. And I love some of the things like these opportunity funds. But this SALT tax thing just doesn't make sense to me. It certainly has undone some of the benefits. I'm okay with the exemptions being gone. I'm okay with higher standard deductions. But boy, I got to tell you, yeah, you have my vote on that. And it's not that I want to prepare another form for more people, a Schedule A, because it's not that big a deal, and it's not. It's more valuable to clients. I think it's kind of a shame when we got to spend our time trying to move money between our primary residence and rentals, and we're going to try to push out 1 month's payment of interest into the next year, and we're going to delay property taxes for someday when they might change the tax code. So, yeah, that is an issue. So now we're going to move to asset allocation for real estate investors. Did I type correctly? Okay, there we go. So we're going to cover a few things here. Some people asked about this. We're going to fix this up here a little bit. How much real estate is reasonable? Liquid funds for real estate. We're going to kind of handle this all together. This is really a question that came to me, and people are asking it because they want to know how much real estate I think is reasonable to have in a portfolio if you're going to be financially independent, or especially if you're close to or in retirement. My answer to that is it depends. I would not be chasing real estate right here regardless. So it depends on the market. Now, I'm always going to be cautious with things, but sometimes it's a better, yes, that is mine. I'm not sure. Oh, that your market, the market you're in, Rob, is probably more not a good buying market. There's not many good markets right now to be buying real estate for income property. You have to buy the right property. And what is the old adage, location, location, location. You know, if you can't walk into a piece of real estate and make a profit on it, then I don't want to do it. I'll have zero real estate. I used to own a ton of real estate. So here's going to be a confession. And first of all, you're going to think, wow, that's a lot. You must have made a lot of money. Then I'm going to make a second confession. I once owned, through a partnership with my dad and brother, 189 rental properties. Not all at the same time, but we had 40, 50, 60 at a time. We were buying 4 or 5 buildings a month, selling 4 or 5 a month. We were really going through a lot of real estate. Now, most people would say I should be rich by now from that, and I did make money, but the problem is it drove me more insane and took whatever sanity I had left and sent me straight to Crazy Street. We bought a lot of low-end houses and fixed them up, so we did make some money. But keep in mind, in Northeast Wisconsin, I bought a lot of buildings, single-family duplexes, $30,000, $40,000, $50,000, and you turn around and sell them several years later for $60,000, and of course you make money on that. But you have to do a lot of them to make money, and they might have made $50, $100 a month. The first building I ever bought, for real estate investment. I remember it's just down the road from me here a bit, 833 East North Street in Appleton, Wisconsin. Some guy in his 30s had an aneurysm. He died, and the bank wanted to get rid of it. We picked it up for 50 grand, sold it for 75,000. 2 years later, and made $400 a month rent and profit afterwards. Well, yeah, okay. I sound like a hero, but I let me tell you some stories about some things that didn't work so well. I won't bore you with that, but understand real estate is a passive activity for tax purposes, but it can be a lot of work. And even if you have property managers, you still, number one, need to find the right property managers for the market. Two, you still have to make decisions on it. And three, sometimes you got to feed the beast. Sometimes your building needs a roof. Sometimes carpet needs to be changed. Sometimes there's vacancies. Sometimes tenants do nasty things to your property, which is very irritating. So I'm going to bring this back up here, and then I do see Rob has a longer thing I'm going to read for a second and get to. My answer to the real estate dilemma is I like to have real estate in my portfolio. I've always been a homeowner for my primary residence. I've owned a lot of rental real estate as well. I've owned some personally. I've owned some with my dad and brother. Currently, I have an interest in a land contract, which I don't want the building back. There's nothing left hardly on the land contract, so I'm going to let it go. And that's a basket case. That's part of life too. But I made out pretty good. I got paid 10% for like 20 years. So I got my money back quite a bit. It was a fixed deal, and you know what the last 20 years were. Well, the last 10, I've been singing pretty good, and now I'm gonna lose the last $8,000-$10,000. But I made a lot more than that prior to it. Real estate. And by the way, I own my office building. I own my farm, which is 10 acres, my house, that kind of stuff. And I'm trying to think if I own it. I don't think I own any other land right now. I'm always looking. I keep on saying I'm going to do it again. I'm going to buy some more rental properties. And if I saw the right deal, I probably would. My office building pays me $2,500 a month. So my business, Tax Prep and Accounting Services, an S-Corp, pays me, my favorite person, the owner of this building that I'm in right now, pays me $2,500 a month, and it's on a 5-year triple net lease. And that's $30,000 a year. I'm pretty happy with it. I get a lot of tax breaks by doing it that way. I get a deduction for the business. I may want to change that a little bit because of the Section 199A rules with these qualified business income deductions. But that's another conversation that would be quite in depth. For real estate, for reasonable, if you find the right real estate, I'm good with that. Keep in mind, you always have to have a certain amount of liquid funds. If you have real estate, you need to have either the ability to borrow or some liquid funds for doing things like a roof, doing things like changing carpet, maybe some vacancies. I've never had a repair maintenance funds, but I had a reporter, I don't know, about a year and a half ago, called me up, and they wanted me to give my opinion on and how they should report to their readers about having a repair maintenance fund for your rental properties. And I was like, well, you had a lot of rentals, Keith. How much did you keep in your account? I never had a repair maintenance fund, but I always had the ability to pull money. I had working capital, and what I did is once we had more than a few properties, we just had one big blanket loan. So if we sold a property, just drop it on all these houses. Our loan to equity was less than 80% all the time. So we bought a new house. We just said attach it. We put no money down, just attach it to the loan. And anytime money came into the partnership, we just paid the thing off. If we needed a roof, we'd just take the money out. Sometimes we had enough cash flow, and almost every case had cash flow. But if you have one or two buildings, you need to at least have the access to some funds in case you need to. I think that even though the stock market's high, it's always high. I think people still need to be riding out the storm. I think index funds is going to be a key part of your portfolio. If you have real estate, I wrote an article too someplace in my blog, and I literally make the argument you don't need that much. $200,000 in capital would give you enough real estate in many markets, like Ohio and parts of Wisconsin, Indiana, the Midwest, basically, some parts of Florida, even Texas, outside of the far east and far west coast. $200,000 gives you enough money down on enough real estate, probably gives you $3,000-4,000 a month in cash flow. And if there's no hiccups and enough years go by, well, yeah, you can have all real estate and throw the dice, and you have pretty good odds, but they're not really good. They're not like the 4% rule where you have a pretty good success rate in that kind of thing. So I'm reluctant to go that far. I think most people don't want the hassles of real estate. I tell you, well, let me put it this way. There's two kinds of people in my office, okay? My most successful people in my office as clients generally have real estate or they're in business. The worst client I have in my office, because they're going bankrupt, the number one demographic for bankruptcy is landlords in my office. So either you're going to make a lot of money or you're going to make a lot of pain, which you'll feel yourself. So it doesn't seem to have an in between. Real estate done well can be really good, and I would argue should be part of the mix. If you, and at the very minimum, owning your own home or maybe owning a rental or owning some kind of real estate makes some sense to me. What the allocation is depends upon your age, depends upon your market, depends upon your total net worth, depends on liquid net worth, depends on what your spending habits are. So it's really hard to give an asset allocation because I tend to be pretty frugal and I can put all my money to work and it doesn't make a difference, and I have money I can grab from other funds. That may not be your case. If you're early in retirement, if you took early retirement, could be a problem. But I really do like the idea, if you find the right property at the right price, I like the idea because since it's cash flowing, will throw off an income stream greater than what the S&P 500 index fund will do. And it will be an advantage to you to hedge the bet, because the stock market can go way up and way down, all these really crazy things. Real estate can do that. I remember 2008, I get it. But the truth is, the market generally will, for real estate, doesn't get that bumpy. Some markets go down. I think the last time the market went down for real estate in the whole country combined was the 08, and before that, I think you had to go back to the Great Depression. It generally is pretty good. So if you're in many markets, it's very common to see, yeah, you get years that doesn't grow very good. I have clients that buy a lot in Ohio, and for some reason that real estate never goes up. But of course, when it goes down, and the market may go down in, let's say, Denver, it doesn't go down in Tupelo or something. It just doesn't happen because it doesn't have the up or the down. I see Sarah said something, asked a question here. I'm gonna look at Rob's here first. No, I'm saying my question, asset allocation for real estate investor, my main question would be, maybe I should have read that first before I gave you my diatribe. Would you be willing to pay California capital gains taxes and federal capital gains taxes diversified if you are 90% real estate equity in your net worth? Oh boy, I tell you, I've been 90% real estate equity forever because my dad always said real estate, don't touch stocks. I know now I should have index funds and diversify asset allocation with paying capital gains tax is no bueno. Okay. Here's what I would say. Facts and circumstances again. I'm not going to volunteer to pay all that much tax right now. But here's where the new tax code comes in, where SALT taxes are a pain in the tail. Opportunity funds are a real improvement as far as I'm concerned. And we're going to touch those a little bit here. Yeah, that's my last one. So we're coming to the end of this, and then I'll just answer any questions or concerns that you guys have. Would I sell real estate if I had 90% of mine in California? What I would do is I would look at each property specifically. I would not try to sell just because of an asset allocation model. I would sell properties that make sense to sell. Maybe this is a market that it looks like this one's not going to have a lot more. If I keep it another 5 years, it's going to have a lot of deferred maintenance. If I sell it now, I don't have the headache. I think that is more important about asset allocation. would I put it in other states? Well, I would have some index funds. I mean, I like it because index funds truly are passive. I mean, yes, the market goes up and down all over the place, but boy, at the end of the day, I mean, over long periods of time, the market's up and I don't do nothing for it. And I get a dividend thing that comes in every quarter. I like that. Would I sell? Would I sell and pay the capital gains tax? I would not be all that fast to volunteer for that. I believe California, by the way, though, is following federal and opportunity funds. And again, I'm not following all 50 states. I'm trying to read as much as I can, but each state has different rules. I believe California is following opportunity funds. So if you decide, look at it this way. You have $1 million of property, let's say, and you've been depreciating it and it's down to, $400,000, and you can sell it for $2 million. And you say to me, Keith, what should I do? And I say, well, do you really want to get out? And you say, well, yeah, I want to get out of this thing. I want to diversify. Now, you don't have to do an all or none. You can do some, or you can do all of them. We're just going to argue we're going to do all of them. $2 million net worth or asset value, we're going to have $400,000 of basis. You sell all the properties, all one big basket deal. Easy figuring again. What happens in your situation? Well, what happens is the $400,000 is your original basis still left. You can take that, put it in your pocket, put it into an index fund. The $1.6 million, if you put it into an opportunity fund, and we're actually segueing into this here, you can defer that gain. And so let's do this. Let me kind of go to Sarah's question here, and let me come back to this, Rob, because I really want, yes, it's for opportunity funds. Okay, let's do this. Let me look at Sarah's quick question here. Let's go back to these capital gains and opportunity funds. This is just a massive, massive opportunity that I think is extraordinarily a good deal. Every time I look at it, I get happier and happier and like it. If I had a capital gain at this particular point, I would be using this like crazy because let's get to it in a second. Sarah, I decided instead of buying more houses, we invest in Realty Mogul to scratch the real estate itch. Hope you didn't mess up. Realty Mogul. Am I losing my mind? I decided to buy more houses and we invest in realty. Are you talking like in REITs? Realty Mogul. What's Realty Mogul, Sarah? When you do these things live, your mind is always trying to go. So sometimes you don't have time to stop and think of what somebody's asking. If you can kind of clarify that for me, Sarah, I'd be happy to go and answer that. Let's go back to capital gains and opportunity funds. Would I be willing to sell my property if I had 90% of my net worth stuck in the California market? I would certainly be a little nervous having all my money in that one basket. I mean, I would want to at least divest of some of that. And there has never been a better time to be divesting than now because of the opportunity funds. Let me bring something up. I actually did this before I started because I wanted you guys to see this. You're probably aware of this, Rob. Like Fundrise. Okay, so we're going to be discussing the same thing. I've looked at some of these opportunity funds, and Fundrise seems to be the biggest and the best out there. If you look at some of the other Fundrise funds, they're talking pretty good rates of return. They don't talk about rates of return in this thing here because I don't think they really have enough history with it. Of course, it's only a year. It's like a Fundrise. So yes, and I like the idea because there's rules in place for these things. I really think that the opportunity funds make an incredible amount of difference. And let's go back to my notes here, my cheat sheet here. Let's review this. Now, I wrote a blog post on this, and it's extraordinarily in depth, but it's also extraordinarily complex. And I wrote that thing, and I kept on rewriting it. It's like I know what I'm trying to say, but I'm not communicating it, and I'm talking like a tax guy instead of a human being. And I've had some comments back to me saying this is the most comprehensive article on this topic we've seen, and I was hoping for that, but I have to make it usable for you, and right now that is problematic. So let me give you a Reader's Digest version, and sometimes verbally speaking it in a video might be easier for you to understand what this means. So what happens when you sell an asset and you want to get it to an opportunity fund? How do you defer and how do you get tax-free money? Now, first of all, when you sell an asset, that original basis you can take out, do what you want. And that's why I put this like-kind exchange stuff down here. It's not like a like-kind exchange. Like-kind exchanges mean you got to move everything forward to the new building and all this kind of crazy stuff. You're always going up. Like-kind exchanges are not nearly as valuable for real estate anymore because of this. So you sell a property, and let's go back to our other example. $400,000 basis, $2 million is the value of it. You sell it, you get no expenses, let's say for argument, $1.6 million of profit and 400,000 going back into your index funds. You now diversified. You have 180 days to get that money into an opportunity fund. Excuse me. And I've been talking so much today. I'm trying not to drink too much water, then I'll cough more. You have 180 days to get it in, but and this is where it's so hard for people to understand this, so I want to make sure I'm going to harp on this. There is one allowed temporary election and one allowed permanent election. And let me go change this here too, so you can mark this when you're doing this. So hopefully I typed that correctly. And here's what that means. So people will go like, I'm going to make an election and it's temporary and I got to make a new one. That's not what that's what, what normal people think of temporary and permanent is not what they mean here. What happens is when you sell a piece of property, you have this capital gain, whether it's a stock, bond, mutual fund, or a piece of real estate. In our example, we have $1.6 million. You have one election to put that money into opportunity fund. That $1.6 million, that temporarily defers the gain. In 2026, it all comes back. You got to pay tax on it in future deflated dollars. But if you hold it here for 5 years, let me see if I can highlight that. If you hold that investment in Fundrise or Opportunity Fund, then you get a 10% step up in basis, which means you have $1.6 million basis, and any investment in an opportunity fund, even if it's not capital gains, is automatically assumed to have a basis of 0. So you really don't want to put money in except capital gains. Okay, so you're in for 5 years, you have $1.6 million, $160,000 of basis gets added in 5 years, so you pay tax on the 1.6 million and plus, and then we're going to have 160,000. So 1.44 million would be taxable at that time if you took it out. If you wait 7 years, it goes to 15%. So your $1.6 million. $1.6 million times 15%. Now my fingers are going crazy. I keep on wanting going 16 million times 15%. And I did it again. 1.6 million times 15% there. So $240,000. So $240,000 would be the basis. So that would be tax-free. When you put the money in, the one temporary election means that when you put the money in from the capital gain into the opportunity fund, you have to put it all in at once, or what you put in is deferred, but the rest is going to be taxed on the current tax return. I hope you guys are understanding this. Okay, Sandra, we'll jump back to that in a little bit for you then, so I can bring you up to speed. Oh, by the way, newbie question, what does SALT mean? SALT actually stands for state and local taxes. And actually, that would be, if you can see my screen here, this is Schedule A. This is this part right up here. In fact, let me see if I can just, these are test returns they send me for testing my equipment to make sure it's hooking up with the IRS so you guys can see this stuff. Let me show you what SALT taxes mean. And when you see it, you go, oh, that makes sense to you. This one's not going to show a Schedule A. Let me do this. Let me do this in this return. And we're going to go. we're just going to force the computer to do a Schedule A. And we're going to get back to those opportunity funds again too. Here's Schedule A. So this is taxes you pay. So you see state and local taxes. This all in this area right here is limited to $10,000. So you see I put $25,000 as my mock-up number. Okay, great, excellent. And this is this limited part, and that's where the real problem comes from. That's where cell taxes have everybody up in arms. A lot of people are facing that, including a certain accountant we won't want to talk about because I can't fix my problem completely either. I don't have any loans on any of my stuff, and I just have, that's all I have is state and local taxes. My charitable contributions go to business. I have no mortgage interest. So anyway, we won't talk about my first world problems. I have to deal with that myself. I'm the accountant in the room. Let's go back to the opportunity fund. You put in your $1.6 million in 5 years. If you keep it there, 160,000 is going to be tax free. The remainder will be taxed when you take it out. In 7 years, 15% or 240,000 tax free. The the election, that temporary election, means you must put all of that gain in 180 days, all at one time. One election. If you say, I get this $1.6 million gain, and I'm going to put $1 million in now, and I'm going to put in 600,000. I'm going to put $1 million in 30 days. I'm going to put the other 600,000 in 60 days. It's within the 180 days, but when you made the $1 million investment, you made your one temporary election. The other $600,000 will not be deferred. So you'll have a $400,000 basis, $1 million being deferred, $600,000 will be subject to capital gains taxes. And you may choose to do that. You're more than welcome to do that. There's nothing against the rules with that. In 2026, that remainder, so to speak, after the 5 and 7 year rule, is going to go on your tax return. And then it's going to be taxed with future dollars that are going to be deflated, and you're not going to pay tax on all of it, most likely. If you keep the money in for 10 years, then all the gain on the gain, so it becomes tax free. So you have $1.6 million that you put into this thing, and most of it's going to be taxed, but in a future date. In 10 years, if it grows to $10 million, you don't pay tax on the difference between the 1.6 you put in and the $10 million. All that gain is tax free. That is the 10-year rule here. Now, let's talk about the permanent election. What does that mean? Let's say you need money from your account, and you put in the $1.6 million, and you're 5 years into it. And you say, I need $10,000, just a small amount of the big pie. That one act of taking out $10,000 is your permanent election, and at that date, all of it becomes taxable. But it was 5 years, so we get to have a 10% reduction in the amount. But that is your permanent election, and at that moment, it becomes taxable. So the temporary election is when you put it in, and it's temporarily deferring, and when you things are temporarily suspended at that time. And then when you take the money out, you can't take money out in dribs and drabs over time. It's in and it stays there for a while. When you take it out, it becomes a permanent election, and it becomes taxable at that time. What about basis and something? Well, I talked about some of the basis issues. What is deferred and tax-free? I talked about that. What I'm going to do here, we are looking at about 9:45 my time. So we've been on about 1 hour 45 minutes. Facebook will let me go for 4 hours, but we're not going to do that because somebody's got to go home tonight and get some sleep. And I've been talking probably 6-7 hours today, and I'm really these things really do take a lot to remain this elevated, and I want to give 100% because you guys need this. This is very important, and I know I didn't cover these 100% in depth, and I know a couple people left probably went to bed, but you can always review this later. If you want to contact me later through Facebook or through the blog, you're certainly welcome to do so. Otherwise, I'm not going to cover anymore. This is everything I had. I kind of just copied and pasted this into the description. Probably tomorrow I'll add a couple of links as I see fit into the description in the Facebook page for the Wealthy Accountant. I may not get up real early because like I said, I had a long day today. I have about 16 hours in. So I don't have any appointments tomorrow, and Thursday it's back on. And then I get a 5-day weekend. And I got to tell you, this accountant's looking forward to it. And then I have 2 or 3 days on. I have 2 days on, 2 days on, 3 days. I have 2 days on. I got another 5-day weekend. By that time, I'll be spoiled and I'll have to come back to work and it'll hurt. And then it's tax season. So if you have any more questions, I don't see anything coming through. I am glad you guys came. I guess 20, 30 people showed up at some point through this. More people will probably be looking at this later. There's 9 still on here. So that's pretty impressive that 9 people wanted to listen to me for that long. If my dad is reviewing this, you can stop laughing now, okay? Yes, I know. You don't want to hear me talk that much either. I want to thank you guys. You guys have a great evening. I hopefully brought a bunch of ideas to the forefront, some ideas that you could actually use on your tax return. Yeah, you're welcome, Rob. I love it. I'm going to try to keep on doing more of these live videos, but they're not always going to be this long. I'm going to try to get these 15 to 30-minute things where I cover topics. And when they come to mind, I have something good to say. You're welcome as well, Stacy. I really will. And if you have topics you want me to discuss, I love the written form, and I'll write to my heart's content, and that's what I like to do. The extemporaneous, though, and something like I'm doing here, I have notes, but sometimes you say and do things that can be more valuable for people. You're welcome as well, Winnie and Carlene. Thanks for stopping by tonight. You guys all have a great time, and if you have other ideas, just put it in. There is a wealthy accountant group. It's private, but you can get in. You just have to ask to get in. The nice thing is if you ask questions there, your friends and family don't see everything that's going on. It's just the people in that group, which is kind of nice to have a like-minded group of people. That would be kind of nice if you're not a part of that. You can certainly look forward to doing that, because that allows, I mean, we're talking taxes and finances, and you might be okay talking with people that understand some of this, or they're in the same boat, they want to discuss tax issues, but you maybe don't want family, friends, neighbors, and everybody else and co-workers knowing it. So that private group is really kind of a nice thing that I had to figure out, and I'm not a big social media guy, so hopefully that works. One more left, we're down to 8, so I'm going to let you guys go. You guys have a great evening. It was absolutely wonderful doing this. I really enjoyed it, and I hope you guys save a lot of tax dollars on this, and things are good. Stay in touch. You have a great evening, folks. Thanks for coming by.